Welcome, dear traders. You are watching a recap of the Asian session. Asian stock indexes showed a positive dynamic. The US dollar lost ground in the morning. Investors are now optimistic about stocks as they are expecting inflation figures to be upbeat. If inflation declines, the Fed is likely to end monetary tightening. At the same time, sentiment improved amid the likelihood of new stimulus measures by the Chinese government. They could help boost economic growth, and the US inflation report is on tap on Wednesday. Traders are waiting for this data with a bated breath, as it will give more clues about the Fed's monetary policy prospects. Today, the economic calendar is almost empty. There are no drivers that could trigger volatility. Investors are mainly focused on inflation figures, which are scheduled for tomorrow. US bonds, as well as the US dollar, dipped ahead of the CPI release. The yields of 2-year and 10-year Treasury notes fell below 5% and 4%. Respectively. At the very start of the Asian session, the MSCI Asia ex-Japan index increased by 0.7%. US stock futures also rose by 0.06%. Australian shares climbed by 1%, while the Nikkei gained 0.66%. Chinese shares grew as well. China's blue chip index advanced by 0.4% in the Asian session. The Hang Seng index was also in the green zone, having climbed by more than 1%. Traders are waiting for macro stats that can shed light on the current state of the Chinese economy. And this week, trade surplus and loan data are expected. According to Reuters, Yuan loans are expected to grow in June. In May, they almost doubled thanks to monetary easing. Experts in June are projected to decline for the second month in a row due to weak overseas demand. On Tuesday, several Fed policymakers made speeches, and they backed additional rate increases to combat inflation. However, they also hinted that the current tightening cycle is coming to an end. This week, the earnings season starts. Companies included in the S&P 500 index, as well as the largest American banks, will unveil their quarterly results. Analysts forecast is a possible decrease in the profits by 6.4% in the second quarter. The US dollar index dipped following dovish comments from Fed officials. It fell to a 2-month low of 101.74 as investors lowered expectations about new rate hikes. So in the medium term, the greenback could resume a downtrend. The non-farm payrolls report for June signaled a rate increase in July. However, the labor market is weakening. Hence, the Fed will probably stop raising rates in September. A decline last Friday pushed the US dollar into bearish territory. It indicates the likelihood of a further drop versus its main rivals. Bears will certainly be in control if the US dollar drops below 101.60. The yen soared to a 1-month high of 140 amid the falling yields of US bonds and the US dollar. However, the possibility of intervention creates uncertainty when it comes to opening new positions. Japan's top financial diplomat Masato Kanda said that Tokyo was communicating with the United States and authorities of other countries on the topic of currency moves. Japan's finance minister confirmed this statement without revealing any details and warned against excessive short selling of the yen. Despite the fact that there will be no changes at the July policy meeting, analysts widely expect an increase in inflation forecasts. It fueled hopes that the Bank of Japan could give some hints about the adjustment of the yield curve control. Speculation on this topic may support the yen ahead of the upcoming central bank meeting this month. Thus, the USD JPY pair may test the support level of 139.05. To do so, it needs to break through 140.05. If the yen manages to consolidate below this level, it could decline to 136.70. The commodity currencies won back losses on Tuesday amid the drop in the US bonds. The Australian dollar rose to 0.6680. Nevertheless, the USD pair is trading down by more than 3% from its June peak, as the Reserve Bank of Australia kept its key rate unchanged at 4.1% on July 4. Traders were waiting for a 25 basis point rate increase, and the regulator said it needed more time to assess the impact of a tightening and economic prospects, adding that inflation had passed its peak. Meanwhile, Reserve Bank of Australia Governor Philip Lowe said that new rate hikes may be required to return inflation to the target level. However, the rate decision will depend on the incoming data. Tomorrow, Philip Lowe will deliver a speech. The Australian dollar could start a bullish correction to 0.6735. So far, this is the highest level the Aussie can reach. After that, a retreat is possible. Bears will lose the upper hand only if the pair advances to 0.70. The long-term forecast for the AUD-USD pair has also worsened. Now it's expected to grow to 0.6900 by the end of the year against the previous forecast of a 0.74. And the New Zealand dollar rose by 0.2% in Asian trading to an almost 4-week high of a 0.6223. It has been climbing for the third session in a row, yet it failed to stay in a positive territory. As expected, the Kiwi dipped and tested the resistance level of a 0.6225. And now it's likely to go down. The resistance level is located at 0.6219 and the support level is seen at 0.6180. Traders analyzed reports from China, New Zealand's largest export market, and the country provided more support for the struggling real estate sector. It fueled speculation about additional stimulus measures for other sectors in the near future. Market participants are also awaiting the Reserve Bank of New Zealand's interest rate decision on Wednesday, and the central bank is projected to keep its rate at 5.5% after 12 consecutive increases since the end of 2021. Perhaps the regulator will also note that future steps will depend on economic data. That's all for now. Hit the subscribe button and keep close tabs on the market developments with us. See you soon.